Welcome to the deep dive, where we cut through the noise and get straight to the insights. Today, you asked us to plunge into Lucid Group, ticker symbol LCID. Now, this is a company that really embodies high risk, high reward. As of July 23, 2025, its share price was sitting at $3.13. And the big question we're exploring is this: is Lucid fundamentally a luxury automaker, or is it, really a technology powerhouse at its core? Because honestly, the answer to that question holds the key to its huge potential and also its equally huge challenges. This is definitely a battleground stock, and by the end of this deep dive, you'll get exactly why. We've pulled out the most important insights from a comprehensive report to give you that shortcut.
And that question, automaker versus tech powerhouse, it's absolutely critical. You're right. Lucid's current market valuation, around $9.55 billion, it's not really based on today's performance. It's almost entirely driven by investor expectations for its future potential. So understanding its unique position, its tech, its backing, that's really key to deciphering this whole complex story.
Right. Okay, let's start digging into Lucid's core operations then with Chapter 1, business analysis. So how exactly does Lucid, operate day to day?
Well, they use a direct-to-consumer model, DTC, much like Tesla does. So they control the whole customer journey, right? From considering a purchase through to after-sales service. It's pretty powerful for building a brand, especially a luxury one.
But isn't that incredibly capital intensive? I mean, investing heavily in physical Lucid studios, service centers, that needs a lot of cash, right?
Yeah.
Especially for a company just trying to get off the ground. Sounds like a really heavy lift.
It absolutely is a heavy lift. That's the sort of flip side of the DTC model for a newcomer. So while their main revenue right now comes from selling luxury EVs, the Lucid Air sedan, and the new Lucid Gravity SUV, which just started initial deliveries in 2025, what's really fascinating and maybe more indicative of their future is this emerging secondary revenue stream, technology licensing. We saw that landmark agreement where Lucid will supply advanced electric powertrain and battery systems to Aston Martin. Look, this isn't just another deal. It's a massive external validation of Lucid's tech prowess. It kind of hints that their real value might go way beyond just building and selling cars.
Yeah, that makes sense. And that tech edge ties into their vertical integration, doesn't it? Designing, engineering, manufacturing their powertrains and batteries all in-house. What's the key insight there? Is it an unbreachable moat, or does it also bring its own problems?
It's definitely a double-edged sword. The insight isn't just that they own it, but what it lets them do, achieve industry-leading efficiency that others, frankly, find hard to replicate. This kind of shifts the argument for Lucid away from just being another car company towards being a genuine technology platform provider. Yeah. That's a much higher margin business model if they can scale it. The challenge, of course, is the immense capital needed to maintain that edge and just the sheer effort of doing everything yourself. It's tough.
Okay. But despite all that tech sophistication, Lucid is still a pretty niche player, right? Where do they actually stand in the market?
Yeah, compared to giants like Tesla, they're tiny. Even Rivian, another startup, is producing more vehicles. In the first half of 2025, Lucid delivered just 6,418 vehicles. Now, that is 38% year-over-year growth, which isn't nothing, but it really underscores the huge challenge of scaling up. Yeah. Their initial factory capacity was only 10,000 cars per year. Their long-term goal, over 300,000 annually. That's still a very, very long way off.
So their value proposition, sustainable mobility without compromise, is aimed at those specific customers wanting luxury, performance, and efficiency, tackling range anxiety, but getting more miles out of less energy, basically trying to stand out through better engineering. Let's zoom out a bit now and think about the wider industry. Let's continue with Chapter 1, business analysis, but focus on the industry analysis. What's the EV market looking like right now?
Well, globally, the EV market is still projected for rapid growth, about 25% in 2025, hitting nearly 22 million vehicles worldwide. So still strong growth overall. However, the U.S. picture is a bit more complicated. We actually saw sales decline year over year in Q2 2025. That's only the third time that's ever happened. And it led to forecasters revising down the full year U.S. EV market share from 10% to 8.5%. Yeah. So it's not a perfectly smooth ride upwards, especially stateside.
And there's a big near-term hurdle coming up in the U.S. market, the federal EV tax credit phase-out after September 30th, 2025. Analysts are expecting this big rush, a surge in Q3, then maybe a collapse in Q4 when that incentive vanishes. That's a huge wave they have to navigate.
It certainly is. And the competitive landscape, it's hyper-competitive. Tesla's dominance is shrinking. Legacy automakers, GM, Ford, BMW, Mercedes, they're all in, leveraging their experience in dealer networks. You've got other startups like Rivian fighting hard. But what's really interesting is the global price pressure, especially from Chinese manufacturers like BYD. They're actually projected to overtake Tesla globally in 2025. That pressure affects everyone's pricing.
Plus, the U.S. regulatory scene in 2025 is, well, uncertain. We have a new administration signaling less support, talking about reducing federal tax credits, maybe rolling back funding for charging infrastructure, even trying to overturn California's aggressive EV mandates. But it's not simple, because many individual states are still very pro-EV. It's creating this fragmented, kind of messy regulatory map.
Right. And all of this just adds to the already immense barriers to entry in the EV market. You need billions for design and factories. Achieving economies of scale to actually make money is a huge struggle. Supply chains are complex, especially for raw materials, lithium, cobalt, nickel, and let's be honest, the lack of widespread, reliable public charging infrastructure is still a major hurdle for mass adoption. It just is.
Okay, we've covered the challenges, but what about Lucid's actual competitive advantage? Let's move into that part of Chapter 1. Business analysis, competitive advantage. What's the thing that gives them a real shot?
Well, this is where it gets really fascinating. Despite all those headwinds we just talked about, Lucid does have this undeniable ace up its sleeve. But first, let's be clear about their weaknesses. Lucid still has significant brand weakness. They just don't have the broad market awareness or the heritage compared to established luxury players or even Tesla.
And that's made worse by their cost disadvantage, isn't it? Low production volumes mean those gross margins are deeply negative. They're losing serious money on every car. Plus, their cheapest Air model is nearly $12,000 above the average U.S. EV price. That naturally limits their market size.
Exactly. But here's the twist. In an industry where switching brands is usually pretty easy, Lucid just got a major lifeline: access to Tesla's supercharger network. Think about what that actually means for a potential buyer. Suddenly, a huge part of that range anxiety concern just kind of evaporates. It's not just convenience, it's a game changer. It removes a key friction point and neutralizes a massive competitive disadvantage. It really lowers a barrier in people's minds.
That is a huge shift. So, given that, what is Lucid's single most powerful competitive advantage then?
Without a doubt, it's their proprietary in-house electric powertrain and battery technology. It delivers industry-leading efficiency and range. That's the core differentiator. It's what lets their cars go further with less battery, which helps reduce cost and weight.
And we've seen proof of that beyond just the Aston Martin deal, right? Like that more recent partnership with Uber and Nuro for a future robotaxi fleet, where Lucid's vehicle architecture was specifically called out as ideal for autonomous vehicles. That strongly suggests their most valuable asset isn't just the factories, but the IP. That really leans into the technology powerhouse idea, doesn't it?
It absolutely does. It suggests their core strength isn't just building beautiful cars, although they are, but engineering the underlying technology, tech that could power a whole range of future EVs and services.
Okay, so after breaking down the business itself, let's look at the people in charge. We're moving into Chapter 2, management evaluation. What's the leadership situation at Lucid?
There was a pretty significant leadership change back in March 2025. Peter Rawlinson, the visionary engineer, chief engineer of the Tesla Model S, he stepped down as CEO. He's still around as a senior technical advisor, so his engineering brain is still involved. But he's not running the show day to day.
And the new interim CEO is Mark Winterhoff. His background seems to be more in operational leadership, efficiency, which suggests the board made a deliberate choice, maybe a pivot, to tackle manufacturing scale and, importantly, cost control.
That transition does introduce some uncertainty, though. I mean, having 3 CEOs since 2019, for a growth company in such a critical phase, that could indicate a bit of instability at the top.
Okay. In terms of communication, the company generally seems transparent, right? Regular earnings calls, public messaging focused on execution and managing expenses. That seems positive for investors.
Yes, generally, although it's fair to say some investors have voiced frustration about a perceived lack of transparency on certain key forward-looking things, like specific pre-order numbers for the Lucid Gravity SUV. It's always that balance, isn't it? Sharing progress versus giving away too much competitive info.
Okay, sticking with Chapter 2. Management evaluation, let's talk capital allocation. Where are they putting their money? How are they spending all that cash?
Lucid is very much in a heavy investment phase, no question. The strategy is focused squarely on internal growth. That means significant R&D for future platforms, They're planning a more affordable mid-size model for the late 2020s and massive capital spending on factories in Arizona, AMP1, and Saudi Arabia, AMP2. It's all about building capacity for the future.
And it seems like they made a pretty smart M&A move too, right? Acquiring assets from the bankrupt EV company Nikola for about $17 million in cash. The report suggests that was a really good deal, getting assets worth hundreds of millions, plus onboarding over 250 experienced EV engineers. That seems like a clever use of capital.
It was indeed a very astute move. But look, as a company that isn't profitable and needs tons of capital, Lucid has absolutely no history of share buybacks or dividends. In fact, it's the opposite. They've repeatedly issued new shares, which has led to significant shareholder dilution. Shares outstanding grew by over 32% in just the past year. And their return on invested capital, ROIC, is deeply negative, somewhere between -25% and -43%. Now that shows they're losing money on every dollar invested right now. That's somewhat typical for an early-stage growth company like this, but it really highlights the very, very long road ahead to actually create value. It's a massive bet on future returns.
Okay, let's really dive into the numbers now with Chapter 3, Financial Analysis. Time for the cold, hard facts.
Right, so quick snapshot. As of July 23, 2025, Lucid's market cap is hovering around $9.55 billion. And again, that value isn't based on current earnings at all. It's entirely about investor hopes for future growth.
And revenue growth. After a slight dip in 2023, revenue did increase by about 35.7% in 2024 to $808 million. And the trailing 12-month, or TTM, revenue for Q1 2025 hit $870 million. That's a 40.7% year-over-year jump, so sales are heading up.
And this is a huge, let's be really blunt about profitability. Lucid's margins are deeply, staggeringly negative. When we say gross margin, TTM is minus 105.68%, that means they're losing more than $1 for every dollar in sales before even accounting for overhead like R&D or marketing. It's wow.
Yeah.
Operating margin TTM is minus 340.47%, and net profit margin for Q1 2025 was minus 155.79%. These aren't just abstract numbers. They paint a really stark picture of the uphill battle they face just to make money on their vehicles, let alone turn an overall profit.
That is a brutal reality. Okay, but you have to mention there has been sequential improvement, right? Like GAAP gross margin went from minus 225% in Q4 2023 to minus 89% in Q4 2024. Still awful, but the trend is improving.
That trend is key, absolutely. But the absolute numbers remain deeply problematic. Lucid also has significant negative free cash flow, what people call cash burn. It's around minus $2.3 billion TTM. And in Q1 2025 alone, they burned through roughly $590 million. This just highlights how profoundly reliant they are on external financing just to keep the lights on. They are truly burning through cash.
Okay, let's look at Chapter 3. Financial analysis, focusing on financial stability. Lucid has never been profitable, isn't forecast to be profitable within the next 3 years. Q1 2025 net loss, $366 million, no profit on the horizon.
Well, their debt-to-equity ratio, 0.53 as of March 31st, 2025, looks quite manageable on the surface, but that's largely because of those massive equity injections from their majority shareholder, the PIF, not because of strong operational performance.
They also have a very strong current ratio, 3.32. That indicates excellent short-term liquidity, plenty of cash to cover near-term bills, but again, that's not from making money. It's because they have large cash reserves from financing activities, from selling shares.
And as we mentioned, Lucid doesn't pay a dividend and isn't expected to anytime soon.
All right, still in Chapter 3. Financial analysis. Let's touch on valuation analysis. The price to earnings PE ratio obviously doesn't apply here because earnings are negative.
Right, so you tend to look at the price to sales or PS ratio instead. Lucid's TTM PS is around 10.8. Now, just for context, legacy automakers like Ford trade at about 0.25, GM around 0.28, even Rivian is down at 2.97. Lucid's valuation, which is actually quite similar to Tesla's at 12.17, just screams future potential rather than current reality. It's a clear signal the market is valuing their technology, not their current car sales volume.
And briefly, discounted cash flow DCF analysis. That's basically trying to figure out a company's true worth by predicting all its future cash flows and discounting them back to today's value rate.
Exactly. But for a company like Lucid, which isn't profitable and is burning so much cash, trying to nail down a precise DCF value is incredibly difficult. It often becomes a garbage in, garbage out situation because those future cash flows are just so uncertain. It's probably more sensible to think about a range of possible values based on different scenarios playing out. And any calculation is extremely sensitive to your assumptions about future growth. Analysts are forecasting a huge 88% per year over the next 3 years. Plus, you absolutely need a high discount rate, a high WACC, to reflect the substantial risk involved here. It's really an exercise in educated guessing, maybe speculation.
Okay, let's shift gears. How is the wider market actually viewing all this? We're moving into chapter 4, market sentiment. What are the analysts saying?
Well, Wall Street analysts right now have a pretty cautious consensus. Hold. Their average 12-month price target is somewhere between $2.68 and $2.91. And that's actually below the current stock price of $3.13. So professional analysts seem pretty wary.
And yet, here's where it gets really interesting, isn't it? Despite those cautious ratings, the general media tone and overall market sentiment recently flipped to very bullish. Why the sudden change? It was driven by two massive positive news events in July 2025. Tell us about the first big one.
Yeah, the first was a major partnership announcement with Uber and the autonomous driving company Nuro. They're planning a next-generation robotaxi fleet.
Yeah.
And this isn't just talk. It involves a plan for Uber to deploy 20,000 or potentially more Lucid Gravity SUVs, plus a significant capital investment in Lucid itself. That news alone caused the stock to jump more than 36% in a single day. Huge reaction.
Wow. And the second piece of big news, that was the announcement that all Lucid Air models would get access to Tesla's huge supercharger network. For owners or potential owners, that's a massive boost to the ownership experience. Removes a big chunk of that charging anxiety.
Okay, let's look at Chapter 4. Market sentiment again, but through market indicators. Lucid is currently one of the most heavily shorted stocks out there. Short interest is running at about 32% to 33% of the free float. That means a lot of market participants are betting heavily against the stock, likely due to those fundamental challenges like unprofitability. Of course, that high short interest also creates the potential for volatile short squeezes if good news hits.
Right. But paradoxically, as of July 23, 2025, Lucid's stock price at $3.13 is trading significantly above both its 50-day moving average, which was $2.37, and its 200-day moving average at $2.55. Technically, that looks strong.
And what's really fascinating technically is that the 50-day moving average recently crossed above the 200-day moving average. That forms what traders call a golden cross, which is a classic bullish technical signal. So you have this stark contradiction. Really weak fundamental financial data, the losses, the margins, the cash burn clashing with this powerful catalyst-driven rally fueled by recent partnerships and these bullish technical signals. It honestly makes LCID a total battleground stock between the fundamental bears and the narrative-driven bulls. It creates a highly polarized, very volatile environment.
Okay, so who actually owns Lucid? Who holds the power? Let's look at Chapter 5, ownership structure.
Right. Lucid's ownership is incredibly concentrated. It's inextricably linked to its majority shareholder, a public investment fund, or PIF of Saudi Arabia. PIF hold a massive 58.1% of the shares. That gives them effective control over the entire company, full stop.
Okay. Other big institutions hold shares too, like Vanguard and BlackRock. Total institutional ownership is around 74%, but direct insider ownership by executives and directors is pretty small, only about 1.5%, and most of that is stock-based compensation, not them buying shares on the open market.
So what does this actually mean for you, the potential investor? That PIF controlling stake is hugely significant. You really have to view Lucid as a key strategic asset in Saudi Arabia's Vision 2030 plan, their big push to diversify the Saudi economy away from oil. The evidence is clear. Lucid's second major factory is being built in Saudi Arabia, and there's that agreement for Lucid to supply up to 100,000 vehicles to the Saudi government.
So this relationship gives Lucid an almost unparalleled financial safety net, right? Near-term bankruptcy seems highly unlikely with such a deep-pocketed backer.
That's the massive upside of it, yes. The PIF provides incredible financial stability. However, there's another side to it. It also means the PIF's strategic priorities, things like technology transfer to Saudi Arabia, creating local jobs there, might sometimes take precedence over simply maximizing short-term share value for minority investors like you or me. It subtly shifts the company's dynamic. It's not just purely about profit. There are broader geopolitical goals intertwined.
Okay, we're nearing the end now. Let's pull things together with Chapter 6. Risk assessment, maybe using a SWOT analysis framework. What are Lucid's core strengths?
Okay, strengths. Number one, undoubtedly, is their superior in-house EV technology, battery efficiency, powertrain performance. That's validated. Second, the strong financial backing from the Saudi PIF, which dramatically reduces near-term bankruptcy risk. Third, their positioning as a luxury brand, targeting that high-end market segment.
And the key weaknesses. Persistent negative gross margins, losing money on every car sold. A very high cash burn rate. Limited production scale compared to competitors, and relatively low brand awareness.
Opportunities. Well, significant expansion potential into the luxury SUV market with the Lucid Gravity. High-margin revenue possibilities from technology licensing and those strategic partnerships, Aston Martin, Uber. And looking further ahead, their plans for a more accessible mid-size platform could really broaden their market appeal, though that's still some way off.
And the external threats. Intense and growing competition, Tesla, legacy auto, other startups, the ever-present risk of supply chain disruptions, and volatility in raw material costs, like lithium and cobalt, which directly impacts battery costs.
Thinking about broader factors in Chapter 6, risk assessment, specifically macroeconomic and geopolitical stuff. Lucid's luxury focus makes it highly sensitive to economic conditions. Things like high interest rates make expensive cars less affordable. Broader economic uncertainty often makes consumers postpone big luxury purchases.
And there's a specific geopolitical threat right now. That new U.S.-imposed 25% tariff on imported automotive parts that came in during 2025. Now, even though Lucid assembles its cars in Arizona, they still rely on a global supply chain for many components, right?
Exactly. And interim CEO Mark Winterhoff has already stated publicly that these tariffs will inevitably increase their costs. That likely forces them to raise prices for American buyers, which could certainly dampen demand for their already quite expensive vehicles. It makes that climb to scale even harder. It's a significant headwind, even with U.S. assembly.
Okay, finally we've reached Chapter 7, conclusion. Let's try and synthesize everything we've discussed. What's the bull case?
Okay, the bull case for Lucid rests on a few key pillars. First, validated, arguably industry-leading EV powertrain technology. Second, the potential to monetize that tech through high-margin strategic partnerships like Aston Martin and Uber. Third, that deep and patient financial backing from the Saudi PIF, which effectively eliminates near-term bankruptcy risk. And fourth, a clear product roadmap for expansion of the Gravity SUV and future, more affordable platforms.
But the bear case is just as compelling, isn't it? The company is profoundly unprofitable with those staggering negative gross margins. There's an immense cash burn leading to ongoing shareholder dilution. They're still struggling to achieve manufacturing scale efficiently. They face huge execution risk in an incredibly competitive market. And now, external headwinds from new tariffs and maybe a less supportive U.S. regulatory environment. It's a really tough balancing act.
So when you try to value Lucid, a traditional intrinsic valuation is highly speculative, almost impossible right now, because earnings and cash flows are so deeply negative. Its valuation today isn't based on fundamentals. It's fundamentally a bet on the distant future. A future where Lucid somehow successfully scales production, finally achieves profitability, and starts generating substantial positive free cash flow.
It's less about a precise calculation today and more a reflection of whether you have confidence in management's ability to actually execute this incredibly difficult transition over the next, say, 5 to 10 years.
Exactly. As of July 23, 2025, that $3.13 share price reflects a market clearly captivated by the recent positive news of partnerships, the supercharger access, and the transformative potential of the technology. Right now, that potential seems to be overshadowing the company's truly dire current financial performance.
So the conclusion. An investment in Lucid today is absolutely a high-risk, high-reward proposition, no doubt about it. It's really a wager that the bull case ultimately wins out. That its superior technology, validated by partners and crucially backed by sovereign wealth, will eventually allow it to carve out a profitable niche. The next few years are going to be absolutely critical in determining if Lucid can finally translate that acknowledged technological brilliance into a sustainable, profitable business. So considering Lucid's unique position, its incredible tech, its huge financial backing, but also its profound operational challenges, how do you think this electric vehicle story will unfold? If you want more deep dives like this one, especially as we cover S&P 500 stocks, make sure to like and subscribe to Stock Analytics AI right here on YouTube. Remember, members get priority deep dives for just $4.99 a month. And over the next few months, we are covering all of the S&P 500 stocks, with members getting exclusive priority access. Or if you just want a one-off deep dive on a specific company, drop us a super thanks.
And just the usual reminder, this deep dive was generated by an AI system purely for educational purposes. It should absolutely not be considered financial advice. Always do your own thorough research, or better yet, consult with a qualified financial advisor before making any investment decisions.